Let's get an investor's take. I'm joined by Charles Morris, Director at HSBC Investment Management. Charles, good morning. Thanks for joining us. Bonds is where the story is. The words came from your lips, or you wrote them down. Why is that? Because bonds, principally in the US, Germany and elsewhere, yields are at or around record lows. We know about the periphery markets across Europe. They're having a trickier time. But what actually is the bond market across the world telling us right now?
Well, I think it's a very good question, Mark. I think the first point is we went into the bond market in March when inflationary expectations were quite high. That was a good time to get in. The market's rallied very, very sharply. The market is now very, very overbought. Now, some people would interpret that as deflationary expectations are very, very high because the market's done so well. But what we'd say is that both the conventionals and the inflation-linked bonds have done well together. That's different from 2008. In 2008, inflation-linked bonds collapsed, conventional bonds rallied. This time they've both gone up. So I'd say that it's a bond market bubble more so than it's a deflationary.
So if there's no
move.
concern about deflation, why is so much money going into government bonds?
Well, I think that's a very good question. In the first instance, I think we've had quantitative easing. That's taken a lot of supply off the street, if you like. So I think the market's quite tight. I think, Manus has been talking about investor sentiment. The sentiment on bonds has been very, very negative. The biggest negative reading we've had on the Commitment of Traders data in years in March this year. Now, I think we've got a very, very short market. In the last 3 weeks, those shorts have gone to neutral and slightly beyond. And so I think what we've actually had is a monster short squeeze.
So you're saying it's a bond bubble. What will it take then to burst this bubble? Because, I mean, you've sold your long-term holdings, so you're getting out.
Well, we had 30-year, 25-year Treasuries. We sold them last Friday. Yeah. And it got to the point where I couldn't sleep at night. And I thought, this trade's gone so good. There comes a time when, you've got to take your profit. And so we got out of that trade and now sitting on the sidelines doing absolutely nothing. And I feel much more comfortable in that position.
What happens if the economy does, though, worsen and we go into a double dip? Would you regret that move or not?
There's every likelihood that could happen. I'm not saying it will happen, it may well happen. And if it does, then I think bonds will perform that well because they've already performed so well.
Yeah, the yields are
They're so expensive, it's got to be something else that does well, and I say that's gold.
You did like agricultural commodities, but you just told me that you sold yesterday your agricultural commodities. Why is that?
Similar reasons. Literally, we went in 6-7 weeks ago. We saw that the market was very short. We saw that the long-term trend was very, very strong. We liked the trade, have liked it for several years now, and we've always come in on the dips. And on this occasion, the net shorts in wheat had gone to the biggest net long ever. Bigger than 2008 in just 6 weeks. And so this is a really tough market. There's nothing to do out there. Everyone's scrambling on the stories quickly. So you find something, you've got to take your profits fast.
So you made money, obviously, in bonds. You made money in agricultural commodities. You're sticking with gold.
It's not always that good.
It's not always that good. But you've stuck with gold.
Absolutely. We've been there.
Does that tell us about the defensive nature of your stance or not?
I don't see gold as a defensive trade. I see it as the leading bull market on earth.
Okay.
It started in 1999, if you like. I mean, I remember coming on Bloomberg Television back in 2003 talking about gold at 330 when it broke out. Anyway, but now we are at 1250 or thereabouts. And we've got the best Sharpe ratio of any trade on earth. We've got a big liquid asset. It's up fivefold in the last decade. It's got low volatility. Emerging markets went from 1,000 down to 300 in the last bear market. Gold went from 1,000 to 700 and then to straight to 1250. Yeah. So what would you rather own? I think it's the leading risk trade. And I'd assume that in normal circumstances it would be correlated to equities.
Charlie, wish we had more time. Next time we will chat more. Thanks very much indeed. Charles Morris there from HSBC Investment Management.